Hello everyone out there. How are you all going? I am Kate Hill, bringing you the best, unbiased, honest content on property, along with fantastic hints and tips. Stay tuned today for a little review of what property prices might do in the financial year 23-24. Now, according to a domain, Australia's housing market will be in a very well-established and steady recovery over the 23-24 financial year. House prices in Sydney, Adelaide and Perth and unit prices in Brisbane, Adelaide and Hobart could have fully recovered from the 22 downturn by the end of the next financial year. Adelaide and Perth house prices are predicted to rise quite slowly. They might avoid any downturn altogether, but see a period of more modest, maybe even sideways growth, for which, of course, Adelaide is renowned. Population pressures will drive housing demand and property prices higher, particularly with the momentum in lifting temporary and permanent visa grants to alleviate the skills shortage here. This is occurring at a time the construction industry has experienced unprecedented headwinds, skills shortages, supply chain disruptions and soaring construction costs. Higher construction costs have created an industry-wide slowdown and could eventually feed into higher property prices, with pre-existing housing undersupply worsened as a result. While prices are expected to rise, affordability will contain the pace of growth as rapidly rising interest rates and the serviceability buffers placed on top have seen the maximum borrowing capacity shrink significantly. The population rebound will lead to larger migrant arrivals, of course, over the next few years, with migration caps returning to normal levels from the financial year 25. Population growth from overseas migration places greater and more immediate pressure on housing demand than natural increase, as they often need to rent or buy when they arrive. Whereas natural population increase results in more gradual housing pressure. So net overseas migration is estimated to be a record high over the current financial and next year. We estimate almost 300,000 additional dwellings will be needed. Over the financial year 24, net overseas migration will drive demand for nearly 130,000 extra dwellings across Australia, with New South Wales, Victoria and Queensland receiving generally the largest share of migrants. Now, typically overseas migrants rent on arrival, but with this very tight rental market Australia-wide, we may see some arrivals transition to home ownership a lot sooner as they seek more stable housing alternatives. The rise of migrant numbers will also make rentals seem like a better investment option, and the shift to home buying from migrants will exert upward pressure on property prices, particularly in the current undersupplied market conditions. The construction industry has experienced some really pretty strong headwinds over the past few years. Skills shortages, supply chain disruptions and soaring construction costs. The costs to build a house has risen by 32% since the beginning of the pandemic. Just think of that. And output costs are up 22%, creating a shortfall absorbed by the construction sector. Higher construction costs could eventually feed into higher property prices. Now, these cost pressures have created an industry-wide slowdown, have blown out construction timeframes between commencement and completion, and had a negative impact on the financial feasibility of projects. Housing construction is expected to contract even further over the financial year 24 before starting to recover. Pre-existing housing undersupply has worsened as a result and is likely to continue deteriorating, exerting pressure on prices upwards. Supply. One of the backbones underpinning the pricing recovery early in 23 has been the unseasonally weak flow of new listings since spring, still 11% below the 5-year average for the combined capitals. The pullback from sellers has been greater than that from buyers, resulting in total homes for sale edging 19% lower than the 5-year average for the combined capitals. Total supply is also lower over the past year in Sydney, Melbourne, Brisbane, Adelaide, Perth. This signals rising competition between buyers, helping to stabilise or improve prices in certain markets. The recent surprise cash rate hikes from the Reserve Bank may be enough to keep the pent-up supply on the sidelines and keep prices moving upwards. Borrowing power. The amount you can borrow, your borrowing power, influences obviously how much you can spend on a home, your buying power. Rapidly rising interest rates and the serviceability buffers placed on top have seen the maximum borrowing capacity shrink significantly. Now, for some, this can change and completely eliminate their hopes of a property purchase. For others, it might steer demand to the affordable end of the housing market, whether that's cheaper property types or more affordable locations, which has already been happening. We have seen in recent months that economic conditions can change rapidly, and this could equally be the case over the next 12 months. The market is pricing in interest rate cuts from early 24. Now, if this eventuates, we may see an increase in borrowing and buying power, which will, of course, exert upward pressure on pricing and the housing market. Typically, a catalyst sparks the commencement of a price cycle, such as interest rate cuts or a favourable demand-driven policy that brings buyers to the market, like a first home owner incentive. Now, some are concerned about the so-called refinancing cliff. Up to 880,000 Australian households will roll over from fixed to variable interest rates near the start of the next financial year. It is already happening a bit. These mortgage holders have been insulated from the last cycle of rate rises, and given the high costs of holding debt, mortgage repayments will be substantially higher and might push some owners into distress. Reduced borrowing capacity may mean refinancing could be challenging for those who overextended and bought close to the peak. If this occurs, it will inevitably exert downward pressure on prices as many try to exit the mortgage club. However, the exact effect of the fixed rate cliff remains uncertain, pending the rollover to variable mortgage rates. It also doesn't take into effect that not all 880,000 households overextended themselves. So many of those buyers had large amounts of cash with which they bought property. Domain data shows distressed listings remain low at 2.8% across combined capitals and 2.7% across the combined regionals. Now, this is significantly lower than an all-time high of late 2018 at 5% for combined capitals, coinciding with the previous significant downturn that spanned 2017 and 19, and 5.7% for the combined regionals in mid-2013. The start of the pandemic witnessed a sharp decline in distressed listings due to mortgage holidays and savings buffers built up due to the extended lockdowns and border closures. The current low levels of distressed listings are a positive sign for the housing market, and even if there are some distressed sales coming onto the market, we should keep in mind that these may simply bring our new listings figures and stock on market averages back into some sort of a balanced market. I will keep you posted on all things property from around Australia as our year progresses. Don't forget to like and subscribe, and I will see you all again really soon. Bye.